Hello, everyone, and welcome to the final session of today's ANZ CFO Summit. We'll be diving right into sustainability in finance with Imi, the Channel Partnerships Manager at Trace, the carbon accounting platform, along with Misha, founder at ESG Custodian, the SaaS solution designed to bridge the gap between your organization's sustainability objectives and its financial performance. My name is Tori. I am the Senior Marketing Manager at Wheel. If you're not familiar with Wheel, we are the leading spend management solution in Australia, helping finance teams of all shapes and sizes to control spending and streamline their back office admin. Now, before we dive in, a bit of housekeeping. I'd like to start with a thank you to the sponsors. Wheel is the team behind this event, but we couldn't do it without our wonderful sponsors. So a big thank you once again to CFO Magazine, Translucent, and Fathom for making today possible. Now, in case you're only just joining us, a quick reminder of the house rules today. We do want this session to be interactive, so feel free to ask any questions in the Q&A function. And if you have any comments, please do engage in the chat as well. We'll do our best to field any questions within our time slot today. So before we start, I would love to introduce our expert panelists for today's session. Imi, I'd love to start with you. If you could give us a bit of an overview of Trace and your role there, that would be great.
Brilliant. Thanks so much, Tori. Hi, everyone. My name is Imi Jakes. I am, as Tori said, the Channel Partnerships Manager at Trace. We're a carbon accounting software platform based in Australia and the UK. And we, in a nutshell, help companies to measure and manage their carbon emissions. We've been around for about 5 years, kind of developing our software and helping those companies to find efficiency as they go through their carbon measurement journey. And our ultimate aim is to help companies to reach net zero. So decarbonisation is a really important topic to us. My background is in environmental risk, and I've worked in the climate and environmental disclosure space for pretty much my whole career, from the UK, Netherlands, Germany, and now here in Australia as well. So hopefully I can share a little bit about that background. But thanks very much to Will for having us here today.
Thrilled to have you, Imi. Thank you so much. Misha, I'd love to hear a bit more about your role at ESG Custodian.
Yeah, thanks, Tori. Thanks all for joining. My name is Misha Veen, originally from Holland, basically. I have a finance background or a qualified accountant and transitioned through my career basically from finance to operations to supply chain and ended up in sustainability. ESG Custodian is a platform basically that connects sustainability, and that is anything from biodiversity to carbon footprint to modern slavery, everything basically to the financial performance. And what we do is basically we have an actionable roadmap with many initiatives, more than 1,000 initiatives, basically business cases that organizations can select and execute. And all that data then gets converted into the disclosure requirements for Europe, Australia, New Zealand, Canada, California, etc., etc. We are about 2.5 years young. So we are a bit younger than that, basically, but very much on our focus is connecting the financials with ESG. Thanks, Tori.
Brilliant. Brilliant. Thanks, Misha. We've got a lot to cover in the final session for today. So I think without further ado, we will dive straight in. And I'd love to start with a bit of scene setting for our audience. We know that sustainability reporting requirements are ever evolving, and a lot has changed recently. So I was wondering, Imi, whether you could just give us a bit of context around where we're at, what's changed, and what finance leaders today need to know.
Yeah, absolutely. I think, starting with it's actually quite an exciting space to be working in the sustainability space, particularly with accountants, which is what we're doing at Trace through our partner program, because there is so much evolving regulation, and especially here in Australia. So I think at the moment there's around 27 countries with mandatory climate disclosure legislation in place around the world. We obviously don't have time to cover all 27, but hopefully the most relevant ones are for the region here in Australia. But in the EU, there's the Corporate Sustainability Reporting Directive, the CSRD. The UK has the Streamlined Energy Carbon Reporting, the SECR. New Zealand's got the climate-related disclosure regime. And then in Australia, we're now impacted by the ASRS S2 standard. So, I mean, kind of focusing down on Australia, just late last year, the Australian Sustainability Reporting Standards adopted the AASB S2 standard, which came into effect at the beginning of this year on the 1st of January. And this aligns with the global reporting legislation from the IFRS and aligns to their S1 and S2 standard. So the S1 standard is all about the voluntary sustainability related financial disclosures, and then the S2 is the one that kind of the big one because it's mandatory. And it's the mandatory climate-related financial disclosures, which are impacting thousands of businesses in Australia over the next few years. And again, Australia has adopted the same standards here, so the IFRS S1 and S2 here in Australia are the AASB S1 and S2 standards. And so there's a bit of a rollout and who needs to report against these standards over the next few years, starting, as you can imagine, with the largest companies first, which in 2025 includes 2 of 3 criteria across, so 500 employees or more, 1 billion in consolidated assets, and 500 million in revenue in year 1. So 2 of the 3 of those criteria. 2026, that ramps up to 250 employees, 500 million in consolidated assets, and 200 million in revenue. And then by 2027, this is quite a large group at 100 employees, 25 million in consolidated assets, and 50 million in revenue who are required to report. So the ASRS estimate that will be 8,000 or more companies just in those groups 1, 2, and 3 by 2027. But it's important to note here that scope 3 emissions, which are those that come from your entire value chain as a business, so all of your suppliers, are a piece of your own puzzle. So they make up part of your own footprint. So there's a lot of companies that will sit in those groups 1, 2, and 3 who will be asking their suppliers to report to them. And so while there might be 8,000 approximately businesses mandated to report, we estimate that could be as large as 80,000 or more who are required to report because they have a customer who they need to disclose to, who sits in those group 1, 2, and 3 brackets. And then the kind of next question we always get asked from this point is, well, what is it that you actually need to be reporting? So to comply with the AASB S2 standard, businesses need to publish an annual sustainability report that gets submitted alongside their financial statement, covering kind of 4 key areas across governance, so board and management oversight of climate risks and opportunities, your strategy to handling these risks, your risk management, so what's your processes for identifying and mitigating those risks, and then finally metrics and targets, and that's where carbon accounting and software like Trace kind of fit into the puzzle, because you're required to measure and disclose your scope 1, 2, and 3 emissions. So that's your greenhouse gas emissions emitted by your business operations, both directly and indirectly, plus any company set targets around that as well.
Brilliant. Thank you, Imi. That was a really expert overview that I think we all needed to kick off. So I appreciate that. Misha, I know that you have a kind of global perspective on this as well. I'd love for you to give us a bit of a comparison of where those reporting requirements or how those reporting requirements in Australia and New Zealand compare to the rest of the world, and are they moving in the same direction?
No, it's definitely, EMI has been very clear and very precise around basically all these requirements, very, very good kind of things. And what you see globally, you see the same trends everywhere else kind of things. I know that Australia is definitely looking at Europe, at the CSRD, basically, like EMI said, basically as almost like the guidance. And what you see more and more happening, for instance, in Europe, as a good example, basically, in a year of, what is it, two, you are not able to actually do your reporting on Excel anymore. They basically expect you to use a solution, a technology, because they want to do, as they call it, XBRL tagging. So the EU basically wants to have direct links to those softwares to make sure what people are reporting, it's almost like your financial reporting, is actually accurate, correct? So it's almost going back to the Sarbanes-Oxley days, X years ago, basically, where everything was far more targeted and the reporting had to be done properly and the controls had to be put in place. This is exactly the same route that we see here. So we see exactly the same things happening within this space. And at the moment, definitely in Europe, but also in parts of the US, of course, not the majority of the US, basically, but definitely California, which is still going very strong, basically, most likely because of the bushfires that happened there basically in the summer. The governor is basically still very much going full steam ahead. But what you see there in that space is that, yeah, the reporting becomes almost like a parallel P&L. So you need to actually report your financial P&L, and what you now see starting to happen is you create a nature P&L over your carbon footprint or your whatever the P&L is called, basically. But you almost create two P&Ls, one that is climate related and one is your financial P&L, so you can actually link them. So it does become, and you see that what Imi said as well, it does become almost a connection to IFRS more and more and more. And you see that definitely in other countries, and it is just a matter of time when it moves over here. It's already starting.
So interesting. Thanks, Misha. And with all these requirements to take into account, what are a couple of things, or at least a few things that you can think of that finance leaders need to be taking into account this year? When it comes to prioritization, is there anything that should be at the top of that list?
I guess basically what the government basically believes is you need to show progress. So all these climate statements, all these reports, it's almost like your audit report from a finance perspective, correct? You have a deficiency, and as long as you can show that you're actually trying to mitigate it, or you look at your impact, or you reduce your risk, it's the same kind of model kind of thing. That's why finance leaders are in a very good position, because it's almost like a daily or an annual or a quarterly process that they're going through as well. So what is important is that you need to show that you're actually doing stuff. And that's where all the greenwashing comes in, basically, where companies promise the world, but you can't show anything. So what becomes more important, and Imi already alluded to that as well in their software, and same thing in our software, basically, is capturing the data, right? Capturing the data and show that progress. Show basically that you reduce your carbon footprint, or you are strengthening your modern slavery practices across your supply chain, or you're basically doing biodiversity, or you're looking at your risk or your leadership, executive pay. It's all those kind of things. So it's basically, you need to show progress basically around your activities. Now, I know that a number of years ago, basically, people come up with, oh yeah, by 2030 we'll be net zero, and by 2050 we will be this, and all these targets. What starts to happen now, basically, is people expect that you start to hit those targets, correct? We are getting closer. So for finance leaders, it is just start pragmatically. That's a big tip. Don't start creating a roadmap for the next 20 years. It doesn't work. But what can we do tomorrow? And some of these things are not rocket science. It sits across your whole value chain. It sits across your organization. It can be small things, I always say, basically. So there can be things like, if you think about let's say you have a fleet, or you have your supply chain going to customers, it can be simple things like introducing a route optimization solution that actually reduces the lengthy routes that you normally have to your customers. And now it actually reduces it, and therefore your fuel bill reduces, but also your CO2. So it can be very pragmatic. So it's all about basically creating initiatives that make sense for the business, not only operationally, financially, and of course sustainably. That's the only way that it resonates.
I think that leads me really nicely into the next question, which is that that whole idea of shifting those reporting requirements into how do I make that a competitive advantage for my business, which I know is what you two are all about. So Imi, I'd love to get your take on that first. Like how can sustainability reporting become a competitive advantage for finance leaders?
Yeah, absolutely. And I think, like, kind of building on what Misha has said as well, there is that there's a few drivers of why people are starting to have sustainability on their radar, as you know, and the climate disclosure regimes on their radar. And we've talked about the mandatory reporting requirements, we've talked about the supplier pressure. But there's also a huge voluntary market already reporting their emissions or other kind of climate-related credentials, those targets that Misha mentioned, voluntarily without having to report it to anyone. And that's because there are other competitive advantages to doing this. And one that I often come back to is the opportunity around kind of brand storytelling and marketing that comes with this. You know, it creates a nice story for your business to be able to talk about if you are really hitting those goals and making tangible changes and reductions in emissions or whatever impact it might be within the business, that you get to then shout about. And you know, up until kind of more recently, as the mandatory reporting requirements have come into effect, at Trace, about 80% of our customer base has been voluntary reporters. And so we've seen businesses all the way from your kind of sole trader all the way up to, you know, businesses with a few thousand employees voluntarily reporting and using this as a way to tell that story. But it's not just your kind of direct customer base, which is an important stakeholder for that storytelling component, but it's also important for investors. You know, if you're going out for tender and pitching for a piece of business, it's a way to differentiate your business and show that you're not just about kind of your profit, but you're also about some level of purpose as well. And I actually just got shown a really interesting report by McKinsey earlier, which shows that growth outperformers, profit outperformers, and ESG outperformers, if you put all those three elements together, the potential for your performance of your business increases 10%. So your business return on that investment across all three is 10%, which is a huge outperformance in comparison to any business just doing 2 out of the 3 of those. And so there's been this myth historically that ESG is a bit of a drag, and that it actually holds you back from, you know, kind of exceeding in other areas, be it growth and profit. But actually, you know, this report shows that it's absolutely not true, and there's huge gains to be made by incorporating ESG into the core of your business. And the other thing I wanted to really touch on here is the competitive advantage of holding good talent within a business, because employee retention is at an all-time low, employee satisfaction is at an all-time low, and it's proven that companies who care about sustainability and climate action create a more satisfying environment for their workforce. And that's not just because they're, you know, kind of saying that they're doing things and putting targets in place, but because they're involving their employees in that the value of that work. I found a study a few weeks ago, I think it's PwC study from last year, that shows that 19% of workers value a company's ESG policies as much as, if not more, than their own salary, which I just thought really shows that there's been a huge shift in focus in, you know, what people value as a business. And if you think about the business cost of employing someone, you know, there's typically around 30K for an average business in AUD. imagine if you were able to retain more of your workforce and not have that ongoing cost of a high employee turnover. So there's much more than the compliance tick box that offers you a competitive advantage, and those are just two of many examples. And I'm sure, Misha, you probably have more.
Now, as you said, Amy, I think we even discussed one basically, which popped into my mind directly. Basically, there's most governments are starting now to expect basically that you have sustainability requirements as part of your tender process. If you don't have it, you can't even tender, correct? You can't even go, and it starts to move into the larger businesses. So I think coming back to what Amy said, basically in the fact that although it's group one that requires to be mandatory, etc., it filters automatically through because they need to be they have the mandatory requirements, and definitely in Europe and definitely in Australia and other countries, basically because that group is required to report, it filters down. You saw the same thing in modern slavery. And that was all, ASX companies had to comply to the modern slavery statement, but it was all pushed down, even to a point basically that I was asked by small business saying, I get 20 requests from all these ASX companies. How can I standardize my answers back to them? How can I actually not have to answer all these individual questions? How can I create some kind of basis that I can actually easily respond to all these? And that will happen. That will continuously happen. So at one point, it is just easier to have it in place, because then if these companies, if your potential customers or future customers basically want to have that information, you can just turn it around quite quickly. So that is something that definitely I see. And from a financial perspective, as Amy said, basically there is an overload of studies and research, etc. But it's not only studies and research. We can see it on a day-to-day basis. I've been in operations and supply chain or manufacturing, all those areas. You can just see basically that if you have a flow through your warehouse, you have less waste. Because you have less waste, it of course reduces costs, but therefore also reduces the requirement to get rid of that waste. So there's so many examples as Amy said basically, and we can sit here probably for the next hour basically and sum up all the financial benefits.
No, I think that's a great little snapshot of just how many incentives there are to get on board with the reporting, because it's happening now, and we shouldn't delay. I did have a question. I know, Imi, you touched briefly on greenwashing, and I wonder if you could just break down maybe the distinction between how to tell the difference between some of those initiatives that might be a bit more performative, not that impactful, and what tools are there to kind of tell the difference between initiatives that can actually really make a difference.
Yeah, that's a great point, and something we talk a lot about at Trace as well, because people come to us and they go, oh yeah, we've put a target in place, and we're going to reduce our emissions by X amount by X year. And they don't yet have their emissions measured. And so you think to yourself, how are you able to say that you can reduce by that amount, having not yet taken stock of what it looks like for you today? So it's really interesting, and greenwashing gets such a bad press, and it kind of rightly so, because this is all about transparency and bringing truth. But at the end of the day, I think it really comes down to people not understanding all the terminology around sustainability. People don't understand what carbon neutral is, and they don't understand that using the term green is actually extremely vague, and how do you define that? And so there's a huge educational gap that needs filling to help lift companies out of the potential for going down the greenwashing route. And it really starts with measurement and disclosure, and using a credible source and a credible methodology for making those measurements and applying a framework for setting targets. So from a greenhouse gas measurement perspective, the greenhouse gas protocol is typically considered the kind of global best standard for methodology for measuring your carbon emissions. And so if you're following that guideline properly, then you can kind of trust in your own internal measurement enough to say, okay, if we're publishing this, it's backed by globally recognized methodology. Whereas, you do hear of businesses out there who've applied a more basic methodology, which might give you a good snapshot or a good idea of where you might sit, but it's not actually deep enough to show you the true value. So I think it's really important to engage with kind of that global methodology. And also, as a consumer, or sitting on the other side of it, questioning those claims that you see made by companies, and asking them where they got that information from or how they measured it. And this will help to raise the bar for businesses, because if they're getting those questions, and they know that their consumers, or whoever it might be, other stakeholders, care about that, then it will push them into action and actually taking a more methodologically backed approach to measurement.
Yeah, I think that's a really important distinction. Misha, I'm not sure if you wanted to add anything else on the green.
No, I think Amy highlighted it very clearly. I think it's almost the same thing as in the finance space, correct? You can do zero-based budgeting, which means basically you start from scratch, correct? You start building your budget from scratch, and you have a certain confidence level. So what is expected more and more is basically when you provide your target, you don't only basically highlight this is my target, but also the justification of why you think, and your confidence level of why you think you hit that target. So what is your justification? What's your measurement? What are your assumptions, kind of thing? How do you come to that target, kind of things? But you have different approaches to hit targets. It's the same thing as in finance, correct? You can do, okay, I look at last year and I basically just add 10% to my budget, or reduce it by 10%, or I basically take a zero-based budgeting approach and I start from scratch and I start building up from the bottom up basically what my budget is going to be. It's as Imi said, basically it's what methodology do you use, and definitely in the CO2 space, GHG or greenhouse gas protocol is the one to go for. In every single ESG component, and there are about 15 ESG, everything has its own, call it methodology that you can use, but as long as it's the same thing as in finance or in operations, as long as you choose a methodology that you're comfortable with and that's international recognized, then you basically you can make a start, correct? That's what it is. But yeah, it's interesting to know though that Australia is the country in the world with most greenwashing statements. Yeah, just to give you an idea, basically there was a research probably about 2 months ago, early this year, basically, that Australia is on the top of the list of most greenwashing claims, correct? So they're definitely going to hammer that on down, because they don't want to be on the top of the list. It's very simple.
Wow, I didn't know
Yeah.
that. That's concerning.
Yeah.
I'd love to hear about some of the practical ways that finance leaders can actually start embedding these ESG concerns into their financial decision making. Is there a framework that you can recommend once they've chosen a methodology to really kick off those decisions in a mindful way?
In the end, basically, finance leaders have done business cases for years, correct? It's nothing new, correct? If you do a new project, or you want to improve something in finance or across the business, basically you create a business case, correct? And the business case basically for productivity improvement, or it's for revenue increase, or it's for getting more customers, whatever it is, basically. And there's of course always a financial link to that kind of thing. So practically, basically, it is that. Correct. In the end, basically, it's that. Basically, only you need to put the sustainability component in it. Correct. It's around, okay, what am I now? It's the same thing when you do your finance. Where am I now, and what do I expect? Correct. And you measure the business case on its benefits. So very practically, basically, it's just start building in the sustainability component in your normal business cases that you do, your continuous improvement initiatives, whatever you do, kind of thing. It's just building in an additional, call it metric, and that's the easiest way to start, kind of things. And then you'll find very quickly, basically, if that is another metric that you are assessing your business case viability on, which one will go through or not. Now, it's the same thing if you have your values in your business and you actually have your values lined up and you say, okay, this initiative sits within the value that I have, and therefore this is an important component. Put the sustainability value in there, and it's the same thing. So practically, it's not that you now need to get hundreds consultants in basically to help you doing that. It's just getting the right tools, first of all, to capture the data. And as I said, basically that becomes more and more important because most companies start with Excel, but that is very quickly will be an issue for most companies because it's not recognized anymore by governments to claim that. So that's one thing. And second of all, basically, yeah, start just building in sustainability, and it can be anything, correct? If your focus is around carbon footprint reduction, or your focus is on a more diverse workforce, whatever is linked to it. And that's, Imi said it already, basically what starts to happen more and more, and you definitely see that more and more in Europe, is the sustainability world starts to connect more to the business strategy and the financial strategy, correct? You need to show that connection. You can't just say I'm doing this if there's no connection to your strategy.
Yeah, and I love what you said earlier about the sustainability P&L. I
Yeah,
think that's a great way for our audience to think about it.
it's almost your R&D P&L, correct? If you're doing R&D, if you're doing a new product development or you do a new service, you measure if that one is actually improving your revenue or whatever you want to deliver. It's almost your R&D P&L, and you got your traditional product P&L, and you see basically if these R&D is actually increasing your overall. It's the same model, so it all exists. That's what I'm trying to say. It's not something that finance has never done, and that's, I think, what is important. Finance has done this already for many years. It's just basically putting some contextual setting in that space.
Yeah, absolutely. And when it comes to communicating the importance of sustainability, are there any other considerations that finance teams should be making when it comes to influencing the broader business about those decisions, and how can they help themselves convince the broader team that these sustainability initiatives are important and should be taken seriously? Imi, I don't know if you want to start.
Yeah, sure, I can kick this one off. So I think, I mean, we've touched on loads of examples already, but it's really important to relate to who you're speaking to in this sense. So, you know, if we've talked a lot about how sustainability is actually a financial strategy. We talked about the other benefits of, you know, commercially of incorporating sustainability and ESG policies into your business. So when you're talking to a finance team, you know, you're relating those experiences back to this is what impact it has on the bottom line. You know, that growth, profit, and ESG example is kind of very relevant there. If you're talking to a sales and a customer success team, they're the ones who really care about customer experience and satisfaction and loyalty. And so then you can bring in your kind of brand storytelling piece there. And if you're talking to HR team, you can talk to them about the employee and talent retention and attraction piece that comes with that as well. But an example I wanted to share actually from working specifically with carbon emissions is that a little bit further down the line, a lot of businesses, as they start to, you know, they've done their measurement piece and they're starting to think about the next steps post-measurement. And, you know, the ultimate aim is to reduce the emissions that you're producing in the first place. But as an interim solution, a lot of businesses are still quite reliant on offsets and purchasing carbon credits. As you know, that's accessible in the kind of near term. But you've got to think about that from a kind of investment perspective as well, because at some point it actually becomes a kind of a better solution for your business to start investing more heavily in your decarbonisation actions than it does to pay for those offsets after the fact. So if I just give you an example of a company, you know, medium-sized company that's got 1,000 tons of CO2 equivalent that it's producing annually, and I mean carbon credits. The cost of carbon credits varies wildly, but let's say that they're spending around 20,000 on those offsets. That's 20,000 that they could be investing instead in the prevention of the production of those emissions in the first place. And so at some point you really need to start to kind of do that analysis to understand, you know, could we be more impactful here by reducing those emissions and avoiding those emissions from being created by our business in the first place, rather than just attempting to set the record straight later by purchasing offsets, which is quite widely recognised as not as impactful as just decarbonising.
That's great. I mean, I think that's a really important shift, not just focusing on what you can do now to, I guess, mitigate what's already happened. It's taking a step back, being more strategic, and thinking about, how do we get here in the first place, and potentially where we could be saving those investments into something more valuable, and less polluting. I'm conscious of time, so I do want to just move us on to our last topic, which is on the tools and technologies that play into the sustainability space. Misha, I might start with you. I'd love to hear your take on the role of technology in simplifying a lot of these challenges for finance leaders when it comes to incorporating these new regulatory requirements and meeting these sustainability goals.
Yeah, it's an interesting approach basically, because there are so many tools out there. There's so many solutions out there. But I guess basically what is important is you don't want to have solutions where you sit days or weeks basically entering data, correct? So you need solutions that interface with your existing system landscape, correct? With your application landscape. There's for sustainability, there's a lot of different data sources, correct? It is data sources from operations, from supply chain, from your own organization, etc., etc. So there's a lot of different data sources. So whatever you can do basically to minimize data capturing and have it easy to actually capture the data, that's important. Also, what's important to know basically, you don't need to be perfect from day one. I think people are too focused on trying to get the absolute detailed data. Organizations will have different levels of data available, and you don't want to spend weeks and weeks to collect the data. So just create a baseline, even if you need to use averages, and there are industry averages. If you don't know what cars employees use, you can use the industry average, correct? It's quite well known kind of things, and that's how organizations start. So, but tools help you with that, correct? And it's especially because tools help you to monitor ongoing improvements, correct? You need to do this continuously, correct? And then you have transactional data flowing through your ERP systems. Same thing as financial data, it flows through. So you want to continuously measure if you're making an impact, correct? And that's important. And unfortunately, basically doing it on Excel, and every finance person has been in a situation that their macro didn't work, or drop down basically screwed up their Excel. Everybody has been there. So Excel only brings you so far. Now the unfortunate thing about this whole space of ESG, it's an enormous amount of data. It's seriously, it's an enormous amount of just numbers and information, and Excel basically will start breaking very quickly, even from an SME perspective. So that's important. And then find the solution that you feel will basically deliver the value that you're looking for, correct? If you're focused on a specific area, and it can be anything, modern slavery or whatever it is, then make sure that if you look at more holistically, take those tools. If you're looking at the financials, then use tools that actually connect to financials, etc., etc. So find out basically what is important to you.
Yeah, Imi, did you want to share anything about, where finance leaders should be focusing when it comes to choosing tools that help them with sustainability reporting?
Yeah, I definitely agree with what Misha said there, and the whole purpose of using a tool is to bring you efficiency in the process. I suppose I can talk mostly from the carbon accounting perspective here, given Trace is a carbon accounting platform, but it's really about finding the tool that connects with the systems that you're already using. And if you're using an accounting software platform, Xero, Mile, QuickBooks, whatever it might be, you don't want to then be using a tool that isn't integrated with that in some way, and you've still got to do some data processing and some data wrangling to get you to the point of being able to bring yourself efficiency. So yeah, that's you need to find the right tool that fits your existing processes. And I suppose from kind of a carbon accounting software perspective, The use of a software tool really brings the process down from several weeks of that Excel management and data cleaning process down to connection to your existing accounting platform. An automatic calculation, because things like the emissions factors, which Misha touched on, are all embedded within the software. So it's essentially like using an extremely glorified calculator, which allows you to just kind of plug in the right information. And about 80% of the footprint is kind of completed for you. So you don't then need the upskilling of a team to be able to run a carbon measurement through a software platform. You don't need to have kind of dedicated resources in-house to do that. You just need somebody who owns the process and can actually plug in that data and produce the reports at the end of it. So it's definitely a much more streamlined process. And there's this hangover from the manual carbon accounting days where everybody thinks it's a really arduous task that puts a lot of people off, but it can take as little as a few hours or half a day to complete a carbon assessment for your business. And to have that ticked off the list of mandatory reporting requirements that are needed pretty quickly at the beginning of the process is a huge help. The other thing to mention here is that software platforms in the reporting space are using AI and machine learning more and more now as well. So it really brings all of the kind of industry insights into one place. So again, you don't need that in-house expertise to be able to get a lot out of a platform. So things like mapping the kind of spend in your P&L to an emissions factor, which is how we apply kind of a calculation to what the impact of that activity is. It be automated, and you can read supplier names, and so there's a lot that can be taken directly out of your P&L or your journals that allows you to kind of let the software again take care of that for you. And as well, from an advisory piece as well, everybody talks about AI, but the power of AI to get you to a very basic level of understanding and start recommending decarbonisation pathways based on your measurement profile. It's really powerful, and it brings the cost down from having to engage individual consultants for your carbon measurement and your kind of decarbonisation planning and your net zero plan, from the tens of thousands per project down to the cost of the software, because you can actually get a lot from that process, and the software is basically designed to provide you with the next steps post measurement as well. So yeah, I just think there's absolutely a huge potential of the software and other tools to be that advisory piece as well. And then the last thing I'll say on this as well is I work very closely with accountants in particular who are providing services to their client base on this. So it's not just your in-house financial team and the CFOs who need to be across this, but there's a big reliance on your accounting firm, as a customer of an accounting firm, a client, to look to them to be your trusted advisor, not just in your financial reporting, but also now your climate reporting as well. And so that's why I work so closely with those teams to upskill them in how to launch and deliver carbon services through the use of a software tool like Trace. because there's a huge opportunity for them to now, step into that role and start being that trusted advisor in more than just financial questions from their clients, but also sustainability, ESG strategy, and more from that point onwards. And it's a great starting point and kind of step into the ESG space.
Yeah, and that probably brings me to our final question of today, which I might throw to you, Misha, which is, when finance teams and accountants are starting out, what are some of the common pitfalls or biggest mistakes that businesses can make when they're starting to tackle all of this?
I think I mentioned it already. Basically, people try to dig down too deep. It's almost like doing your financial P&L and trying to actually find every single little expense. Correct? You start with your on GL account level. Correct? So that's the same thing with this. Basically, as Amy already said, basically, a carbon account is all factor based. Basically, so if you it allocates basically a factor to a certain spend or a certain type of activity that you do. Basically. Now, every year, unfortunately, these factors change. Basically, that's just fact of life kind of things. If you need to do it all manually, that is an absolute nightmare, correct? It takes a lot of time. It's not needed kind of things. There's plenty of solutions. Same thing as easy custodian. It's all there kind of things. There's no issue in that. So finance teams basically first start basically understanding basically what is the ESG components. You have CO2, you have your nature positive. What we see a lot basically is that companies move a little bit away from only net zero. They also look at basically how do they affect the nature component, the water management, waste management, especially in the agricultural space where we do a lot of work, basically regenerative farming. How can I get better soil, which actually get better product produce, and those produce, of course, can have premium prices, correct? In the end, basically, and we've seen those proofs. But it starts small. It starts very simple, basically. Okay, what is important to you as a business? What sustainability components are important? Okay, for an FMCG, it will be different than for agriculture, than for a logistics provider, etc. And then basically start with what initiatives will make financial sense and sustainability sense. Let's not forget, basically, businesses can't live only on sustainability, on ESG. But we need to be very pragmatic, and it's very clear, basically. It needs to also make financial sense, correct? In the end, basically, and that is the important step. So logically, that's what we advise, and that's exactly what our platform does, because it has initiative, which is the connection, correct? But yeah, that's what I would say. That's how I would.
That's a great note to end on, is that connection between the finance benefits and the sustainability benefits. I know we had a few questions in the Q&A. We don't quite have time to answer those right now, but the Wheel team will pass those on to Imi and to Misha to make sure they're answered after the session. So thank you so much to you both for joining us today, and to everyone at home for tuning in. That was the final session of today. Before you go, we would love to throw out a poll. So if you would like to hear more from Misha or Imi, please do let us know in the poll that's out now. I'll give you a couple of minutes to answer that. Great. Everyone's had a chance to let us know if you'd like to hear more. A huge final thank you to everyone who has attended the CFO Summit today. We hope you found today's discussions insightful, and you've left with lots of new ideas to bring back to your teams and fellow finance leaders. So we would love your feedback. If you have any thoughts or suggestions, please reach out to the team at Wheel. We are happy to hear them. Wishing you all a wonderful rest of your day, wherever you are. And we look forward to seeing you again soon. Imi, Misha, thank you so much again.